Welcome everyone to the Kendall Report. It is Sunday night. Happy Easter, everyone. So here we sit. I saw somebody mention looking forward to the BRICS commentary. Well, I'm actually not, because I still am working on some things. I was talking to Dr. Baker earlier, and I'm still, I will make some general comments, but I will say this just up front. I don't think this is a big an event at this very moment in time. I don't think it's something, it's more of a distraction. It's the next thing that the market commentators are trying to throw at the market that's negative, that won't knock the market down. So that's, I think I'm going to put it in the category of that for the moment. I'll mention a few more things, but you know, we're coming into just so everyone knows, next week, no YouTube. There might be a minor update. It just depends on what's going on. I'm not going to guarantee anything, but I would just tell you that expect nothing from the 17th of the entire week. So that is, I will be out of town and not available. So let's talk a little bit. This week is CPI, PPI week. And the title of this video is Markets to Get Tested by the Inflation, right? Inflation to test markets. And I think what it's going to end up doing is really just kind of remaining neutral. I think we're in a phase, and I've talked about this for a while. I'm tired of talking about it, actually. But we're in a phase where it looks like we're going to continue to chop around in this range. There doesn't appear, you'll see when we go through the technicals tonight, to be anything that is going to move the markets in a big way, either way, up or down. So sideways chop continuing. The good news is, and I'll show you here in a minute, is that our database continue to get more traction on the intermediate. Excuse me. And so let's go back and let's just go through the economic stuff. I'll talk a little bit about what I and review last week's stuff, but this look forward for a minute is really there is nothing coming out Monday, Tuesday of any kind of consequence. Wednesday is CPI. That's expected to be plus 0.2, and year over year is 5.2. I'm looking for these numbers to flatten out a little bit, maybe even 0.1, maybe flat. That's the expectation on the PPI is flat, but the year over year on CPI is looking at 5.2. Next day we have on Thursday we've got PPI is flat 0, maybe up 0.1, but it's looking 0. If that number came in negative, I think markets will like that quite a bit. I'll try to piece together what that reaction might be before we get there. And then on Friday, we've got retail sales expected to be negative 0.4. Then we got industrial production, and that's positive 0.2. Capacity utilization 78.8, and U of M consumer confidence at 62.5. Just go back real quick on Thursday. We also get the claims numbers. 233 continuing claims are now up to 1.23, and they're starting to climb. And I'm expecting to see those numbers continue to climb. We saw the JOLTS number, new jobs, go down. So we're starting to see employment deteriorate just a little bit. And I think this is going to tell the Fed that there's going to be, they're getting their job done. As far as any of I believe the Fed minutes, I did not see them. I think the Fed minutes are coming out. Don't expect to see anything in there other than fight inflation. There's no way they're not going to pivot, folks. I'm telling you, they're not going to pivot. All caps, okay? Air quotes, all caps. They're not going to pivot. There's no reason for them to. And with for the most part, positive economic numbers and everything that's going on, employment numbers that came out on Friday continue to look pretty good. So here we are in the same scenario, and there's no reason why the Fed's going to change what they're doing. And probably a quarter of a point in the next meeting, and expect that to happen. But we're a little ways off on that. We are not even quite mid-April here, so we'll get to that. By Friday, we'll be midpoint in April. But just don't expect that. Don't make any plays based on the Fed's going to pivot. But you should ask yourself one thing. If they did pivot, would it be positive or negative? I think if they pivot, it'd be very negative. I don't think the markets will do well at all if that happens. I think it would be an acknowledgement of something that we don't know about. I don't think that's the case. I think we pretty much know everything. Powell's made it very clear what they're going to keep doing. And you will hear this for a while. I don't see anything changing my mind at the moment, is that the rates are going to stay higher, like not forever, but for longer than you can imagine, maybe into 25, 26. I'm talking 2 or 3 years. They're just going to be chopping around. I have a range of expectations. I think where we are right now on rates, just to make a quick comment there, is we're pretty much normalized right now. we were artificial at 0 or 1%. Those were not real numbers that the economy demanded. And what the economy demands right now, if the relative risk is right where we are, short end of the market's in the fours and a little inverted in the back end, and that inversion is not necessarily negative. I think it's just reflecting that the demand is down on the back end. You can look at real estate numbers. Well, they're firming up. They're off massive numbers year over year. So that's just really what's going on. I hear people talking about the markets are pricing in stuff. No, they're not. They're not pricing anything. What we're seeing right now is the configuration. Some of you that follow me on Twitter, I'm gonna plug Dr. Baker again, but he put out something. He showed that the QT, they're on track on the treasuries on the QT, and they're continuing. They're behind a bit on the mortgages, but they're going to continue QT. They're going to keep raising rates. Maybe we flatten out. I've always had the expectation of around 5.25, maybe as high as 5.5 as a terminal rate on Fed funds target. I think that's still in play. I don't see any reason to change that. Nothing at all. And in fact, they keep trying to break everything. All these stories about the BRICS and the Dow going down, and meanwhile the Dow is not going down. It's gone down a little bit, but it's not like it's collapsing like you would think it would be. And you've got every commentator that you can imagine hyping up the BRICS situation. So now a couple more comments on the BRICS, and this is my opinion. I mentioned this in a brief. It was kind of a hangout session on Saturday we did. And if you were there, I appreciate you coming in and spending some time with me on Saturday. But the bottom line is on this BRICS situation, there is a big movement. China is making a big impact on the planet. They're big major trading partners with a lot of people, but think about it. I could go around my desk like, oh, the iPhone, where was that made? Probably China, right? Everything's made in China. So you're going to have that event happening. Whether or not they can form a new currency, they can go through this next level, I think that's a long ways off. But they are starting to do direct. It's nothing really new to use the SWIFT system to do transactions between Brazil and China, or Brazil and whatever, or anybody within the BRICS environment. And of course, Russia can't use the SWIFT, but everything's. I mean, I just see it as a pattern that is definitely emerging. Is it immediate? Is the Dow going to lose its status? No, not at the moment. There's a whole lot of things we could go to, and as far as one of the probably primary things when you're looking at currencies is trust. It's getting a little harder after what happened with Russia, and you've seen it with Iran and other, we'll call them rogue nations, that these sanctions, and they went full on where they confiscated money from central banks and froze assets from a central bank. That doesn't feel good if you're one of those central banks. So just know that there is some apprehension with the dollar. There's definitely people thinking about a whole lot of stuff. And then we had this meeting between Xi Jinping and Macron, and that that is what it is. I mean, the French have always had, I said the French always had a little communist mixed in between socialism, communism for a very long time. And, while they joined the Euro, they're still kind of got one foot hanging out the door all the time. So nothing surprises me with the French and from that standpoint. And it's not just the way they've acted from a monetary viewpoint for a very long time. Let me review my notes here. But those are my general thoughts on the BRICS, is I just don't see an immediate threat. And I'll cover the dollar tonight to set this up. Like I said, I'm going to do my best this week to get you set next week. I did make a note to myself that if you look forward a week and look at the economic reports that are coming out, not this week, but the following week, they're pretty benign. We're going to be operating, and I think that's what you'll see here in the technicals in a few minutes, is all you're going to see is that these markets are set up to grind sideways. There's going to be, there's still some slight upward bias, but for the most part, we're looking at a sideways market. So let's go ahead and get into the Wavetech database and get in through tonight's stream and see what's going on. We'll go in reverse order tonight. What we're looking at is the daily database. We're now back up to just about 42%, 41.87. We had basically a rotation. If you look at the number of buys and sells here, there were 248 buys, 234 sells. So it's grinding here. But the weekly database is really what I want to pay attention to tonight. So I'm going to flip over here and just bring this up. The intermediate database is now at 61.36. I mentioned when we were at 58, the next level is 62 to 68% is where this market will move toward. And then it's possible if it gets above 72 to go into the 80 handle. But what's happening is that the duration of these trades are changing pretty substantially. I'm going to go full screen. I know some of this will be fairly small to look at, but this in the middle here, the optimized weekly right now, average days long is 63.9. We'll call it 64 days. That's the deviation. The average long right now, current duration, is 39.39. The average holding is 205 days. And those are market days. And that's a better part of a year from that standpoint. So we are right now about 20% of the duration fulfilled. Now, we don't get to 100% of this being filled. So we've still got about probably 40% to go, somewhere between 100 and 150 days. I'm going to attempt to bring up a graphic here, just so you can get a feel for this, is the historic exposure. So we're around 68%. We're likely to climb up to this 68, 72 level that I just mentioned. And then once we get there, typically what will happen is the database will start to tail off and then we see the market. So the blue line here is the S&P. It continues higher. And then if this is a typical situation, the way the database is going to act, we'll drop back below this 42 red line here, 42%. And then at that point, we start to see a peak in the markets, and then we start to see the next cycle come in from that standpoint. So this is a real typical situation here as far as the database goes. So I don't really see this coming in and deviating from what we already know. So this is pretty common. And I know I remember going back in October and coming in November when we finally started to get some traction on database, and everybody was pushing back on me that, things are going to roll over. And if you look back from the point in time that our database started to get some traction above around 22%, it's just been improving all along. And now we're at 60%. So what that means, we're at 9,653 symbols in trend mode right now. And as I told you, once we got above 42, that this thing just doesn't roll over like that. It just doesn't roll. Last I checked, when we were looking at the screen a minute ago, S&P's printing 4,100. Okay, so we've continued to climb from that 3502 low going back in October. If you recall, the short-term database got very aggressive off of that October lows, and we came into the fourth quarter of last year. We saw some real aggressive buying by the database, and then we saw a bit of rotation in January. But meanwhile, what was happening, the short-term database was pulling back while the long-term database was starting to find more and more emerging type patterns that were likely to emerge. So let me just just talk about this just for another minute and see if the database is right. Well, so far, what I'm showing you, it's different than looking at indexes, and I keep telling you, we're looking at 15,731 symbols, and the point of this is that it's much. You see the what I call the underlying trends that are flowing in here, and I always joke that we've got 9,653 times. This database isn't going to be wrong 9,053 times. Not every one of these symbols that it currently owns and holds is going to make money, but the bulk of them are probably around 60+% will make money, and they'll continue to trend. And as we go forward, we'll get new trends that will emerge. So what happens, if you think about it, the breadth of the market started bottoming in October. There were still a lot of intermediate downtrends then, and then all of the stocks started stacking up and bottoming, and then you see this positive rotation into the database, which equates into stability in the market. We got this big base. How many times have we come back and test 38.50, even 37 handle was tested. It looked like, and there was everything out there to knock this market down and every reason to sell it. And it was everybody was going, we're going to go to, 3,300, 3,200 will happen before we get to 4,200. Well, we could see 4,200 in the next week or so. And the point of all this is that there is a positive rotation. This isn't going to end in the next couple of weeks. I'm going to stick with the story that I showed you on the technicals last Sunday night, which was that we're going to see positive rotation coming in. The deal was March and April. Probably a little bit into May, we could see this thing start to fade just a little bit. But I think ultimately it's July or August when we finally hit a serious wall. We get into Q3 is where this thing is going to start to rotate down. And there's a lot of positive things that are going on in spite of all the negative things that they're trying to be throwing at the markets. So I think just kind of winding everything back to what I said on opening comments is you're going to see, I think, inflation can continue to moderate. It's not going to get to 2%. It's going to stay probably 3.5% is going to be the bottom, but that's going to be enough to maybe take some of the worries out. Folks start looking for opportunities in the markets. Let's face it, there's a lot of money that wants to buy something, and they're constantly looking at something. And as I go through the indexes tonight, it's been my opinion, it hasn't been played out real well, but in our database, it has shown up quite a bit where these secondary stocks are getting buy signals. It's not showing up in the Russell at the moment, and there's still a fair amount of relative weakness there. So we're just not seeing that. So let's go ahead and get into the technicals. Should be able to get through the rest of the show fairly quick. I'm going to keep it pretty lean tonight, and as the week goes on, then we'll talk a little bit more as I set up the week next week when I won't be around. So let's go ahead and get into the technicals. All right, let's start with the hourly chart here. And sort of interesting, tonight we actually started off with a higher note. This is Friday. We got an RTX sell signal on Friday. That's when the market closes above the market grid, which is that orange line there. And what we're seeing is that it's coming back in. It looks like from the algo standpoint, we're going to see it stay under the 10-period moving average, and possibly, as always, it seems, I keep telling you folks this. If you're around, if you're in Europe, I'm jealous because you get to be up and around when the London is opening, and it looks like we're going to get a little bottom here, but we're also seeing a forecast of crossovers to the downside. So there could be some more negativity as we come into tomorrow. So this story is told much better on the daily chart if you look at what's going on there. So let's let's take a look at the daily, and you'll see we still have this upslope here on the averages. We still have the ppm1 is at a positive 0.32, ppm2 0.25. Both of those are trend levels, and ppm3 is also just flat but starting to turn up. So we're starting to see all these average move in an upward phase. So here's where we're likely to trade back to, and I'll go through the market grid here in a second. But we're really looking at the market grid coming back, probably doing an R1, S2 tomorrow, but heading back toward the key support levels 40.94, which is this 10-period moving average. And with a 0.32 ppm1, there's only about a 30% probability to decline below that value. Now we're trading right now at 32. That's about 35 handles lower, which would be quite a bit of weakness to get there. But we should follow this line for the next several days. It looks like the projection, this is really going to be your best trend line, is this simple SMA 10 is going to be your best value to watch. Now, it looks like potentially we're going to cross over in 2 or 3 sessions, maybe toward the taking out the first derivative, and then it's forecasted to do the second derivative, but this is quite a few days out. So these numbers and all this, the forecast will change a little bit as we get real-time values coming through. But for now, at least for the next couple of days, we've got some solid support here with this. ppm2 is likely to stay above 0.25, and that's going to be enough to hold this. And in fact, just a quick number is all that's necessary on these ppms once you hit 0.25 is to maintain about 0.15, and that's enough to usually suggest that that moving average will be a valid trend line or therefore support. And that's one of the things that I was talking a bit about. I wish Saturday's meeting would have been a little bit better organized. As it turned out, it was just kind of a fireside chat, if you will. And so, but the bottom line is that all of the indicators are, you can see the shape of the projections for the moving averages are all pointing up and all that, and it's all good. Those of you that have the indicators, I got to keep saying this, they're not quite ready, still testing some things. I found a little bit of something I'm looking into right now, but we will release these indicators down the road. And I think there's going to be 7 or 8 new ones that are coming out, and they're all part of the dialogue and things that I talk to you about every night in the channel. So we'll get that out. Those of you already bought them, it's going to be just a couple bucks to ante up for the upgrade. And ultimately, I'm working on a project which is Wavetech Signals, trying to get some numbers that we can give you some cool actual buy signals. I show you some of the buy signals on the on TradeStation. We can run them there, but we don't have a way to distribute them in a secure way. So we can't do that at the moment. TradingView, who knows? Things change, and maybe they'll come up with a PineScript 6 or 7 or something, and we can actually do what we want to do from that standpoint. So let's go ahead and real quick, and let's go over to and just take a look at the market grid here. Hang on. I'm looking here, and this is, bear with me. Yeah, the page that I need is not open, so let's open it. Great. Yeah, I had to reboot. I thought I had everything up. Just bear with me 1 second, okay, folks? All right, so here we go. This is the couple things I can show you here. We still have that long position that came in on 327, at 4,008. It's still long that. You can see we've went sideways here. And you can see as I was showing you on the PPMs, we're seeing an acceleration in this PPM too. So that's kind of interesting. Let's take a look at the market grid here real quick, okay? Let me go off screen. All right, so what we're looking at here is, I was mentioning earlier, R1's 41.49. We've had a high so far today, 41.43. So we've kind of maybe satisfied R1. S2 is 41.24, and there is a potential because the narrowing of the market grid of getting down to 41.15 or even STX. There is some potential on the downside here. And like I said, we should trade down into London, but go with right now R1, S2. So that's going to be 24.50 will be the low from that standpoint. And just so you know that this, we may see a little bit of a contraction. There's really no news, like I said, till Wednesday. There's going to have to be running off who knows what kind of news stories that might come out that affect the markets. But it looks like we could have fairly quiet markets. The market grid is actually, let me go back over to over here. Market grid has been contracting and getting smaller ranges every day projected. So it looks like usually when we get that contraction, we're a few days away from another expansion. And it looks like to me that if anything happens, we could, if maybe 3 days out, we could penetrate the 10-period moving average and trade down toward the 21. We could expand a little bit to the downside, but the trends, like as I pointed out just a few minutes ago, are still all up. It shouldn't. All of these things that I just showed you will be relative on all the other indexes. I will show you. I will mention anything that's different from this analysis. I'll make the comparisons here. All right, bringing up the NASDAQ futures. Similar, you can see this is interesting because now the NASDAQ has been the leader, and the daily looks like we've got maybe one more day, 2 days. This is why I was seeing a little bit of downside pressure that we could start to trade down toward the 21-period moving average on the NASDAQ, and that right now is 12,802. The 10 is 13,075. Last trade 13,142. But looking at the market grid here, I know it's fairly small on the far left here, but R1 here is 13,222, which I believe has been basically satisfied. S2 is going to be 13,060, and we'd have to get all the way down to an STX number, which would put us below that 10-period moving average. And right now, the PPM1 is at 0.19. I just mentioned just a few minutes ago that the number that you want to watch for on the PPM is 0.15 as minimum for a support number. So that 10-period moving average 13,075, that's going to be your support. You still have a PPM at 0.19 and a bit above that 0.15, but the next 2 days it stays stable. After that, we start to fade a little bit. So coming into Wednesday could be the point in time where we're going to maybe see some downside. So expect some choppiness in all these markets and potential downside at that level. And always, as always, use, like if we trade above R1, then R2 would be your next resistance point. And that's what these market grid is based upon. And so just know the market grid is estimating the maximum potential range with STX, RTX, and in between, we're just measuring what the probabilities of where the high-low is going to be every day. So that's why it's S1, R2, or maybe S1, R2, whatever the numbers are. So sometimes we get R1, S2, like what's being projected today. All right, next we'll look at the Russell. Interesting, as we're showing the NASDAQ and the S&P are illustrating some weakness. Looks like cash flow positive potentially for the RTY or for the Russell 2000. And we could see some positive coming up. You can see that PPM 1 and 2 are above their first and second derivatives. We're still negative on PPM 2, but PPM 1 is up at a 0.14, and we're trading pretty much right at that average. That number is 1769. Last trade 1773. We're trading just a touch above it. Looks like sideways for a couple of days, maybe some increase in momentum that would push us back toward the 40. But I think ultimately the ranges that you're likely to see here on the Russell are between the 21 and 40 period moving average as extreme. So you're looking at 1769 and the upward range of 1836. And we're also looking at the 10 period moving average is being forecasted that it's going to cross over to the upside. So what that would mean is all the market needs, for that to happen, we're going to have to see the market remain above the 10 and start to trade above these numbers, maybe re-challenging the 200. And the 200 is very positive. So we still have an upslope on the 200. So basically, if you look at the market from this viewpoint, it's kind of out of balance. It wants to get back toward this 200-day moving average. That's going to be where it's seeking that value. So that's what everything's being forecast at the moment. Next, we'll look at the 10-year treasuries. Very interesting look here. We still have some downward slope here all the way down to 325. I know those numbers seemed absolutely ridiculous. Let me turn on the Fibonacci targets here. And there are some minor targets that are sitting right in here. 326.10, 312, we'll call it 313, and 304.45 here on the downside. So the algos are suggesting that we're going to start to flatten out a little bit. We're probably going to stay above the market grid and look for this to move back toward this 10-period moving average right now, which is right now at the 344 level. So that was 354 last week. Now it's 344. That average is coming down, and it looks like we're going to be continuing under pressure here from a yield standpoint. Take a quick look at the 10-year yield, and it's got a little bit different configuration. It does not look as negative. So what's happening is what I was telling you about, that demand on the back end, the 10, 30s are weaker. So you're not going to see those move a lot to the upside, where the front end is where the Fed's doing all the work and where the activity is. We're printing back here at 395. I talked about getting back there the other day, possibility of getting up to the 200 here around 405, 410. I don't see a lot above that. The extreme right now would be probably a 425 on the 2-year. But I think overall what we're seeing here is that the algos are trying to turn up on PPM2, which would tell us we would be moving above this 200-day moving average, which is right now at 200 is 404. So look for that number to be challenged, and then possibly start to print up at 410, 415 plus. So don't see much more going than that. All right, let's cover the dollar here. It's interesting. We'll start with the daily. We'll go a little bit more into this. The algos are suggesting we're going to start to move a little higher, but not anything drastic. I think if we do anything, the most positive you're going to see is that we get moving up toward this 21 period moving average around 102 and the potential getting to 40, 103 and a half or so. And that's, the algos are suggesting a slight bias to the upside, but no collapse. There is a pivot number here. And if you remember, we had a pivot like this in the 10-year that if we got above it would signal much higher prices, and it spiked up through that pivot. This pivot right now is 102.83. So a move above 102.80 is going to set up a pretty decent move, probably into 103 and a half, 104 range. If that happens, I'll cover it. The algos are suggesting mostly stability, slight bias to the upside, probably moving towards a 10-period moving average from that standpoint. And we should see, let me just see what those values are, at least a move, like I said, 102.50, 102.80 should be the range from over the next several days. The key support on downside is just going to be the bottom of the market grid, which is going to be right around the 101.60 area on the downside. So I think pretty tight range here. It doesn't look like anything disastrous, and it goes along with how the treasuries are structured as well. All right, next to crude oil. Interesting because crude got that RTX sell signal on the 3rd, on April 3rd. Basically, we've been sideways in this little formation here for a number of days. And as I've been discussing, it looks like we're probably peaking out right here. We're probably going to come back into toward the 10-period moving average, 77 handle. We're trading right now 80.77. So in spite of the OPEC plus move to drop production, that's holding up for now. But I think it will remain no matter what happens here, well above 76, 78 level. But it does look like we're going to pull back into these averages. And what's being forecasted on PPM1 is that ultimately we roll over and it starts to decline, which we'll talk about that when it happens, whether that's a sign where people are looking at some kind of demand issue or something of that sort. We'll just see how it all plays out. But it looks to me that we should see at least a test of that 10-period moving average should be around 78. We get below that, and we're going to head back towards the 75 level. We should support in there. I don't see any drastic moves to the downside. All right, so we'll cover gold next. Gold continues to climb, although it's trading back toward the 10-period moving average. We're down, I think the last time I looked, we're negative 1430 right now. And so what we're testing that 10-period moving average. That number right now is 1999. We get below that, we should come back toward this level here around, I would say, that around 19, here's that number again, 1960, 1970, we should pull back in. And we did get a bit of a RTX sell signal a couple of days ago, so we're basically sideways in this pattern and moving down. So this will be the key level here to watch. The PPM suggests right now we're at PPM1 is at a 0.1398, so it's below that 0.15 level, makes it pretty vulnerable. Looks like to me that the markets want to head toward that 21-period moving average. The good news is PPM2 here is up at 0.43. So there is about a 70% probability if we were to reach that number, which right now is 1969, probably give it a range of 72 to 69. That would be a buying opportunity that's probably going to be about as cheap as it's going to get in this pattern. But I don't see any breakouts. It's just going to continue in this pattern forward. Let's take a quick look at the weekly. And the weekly patterns still expanding. We got that RXT sell weekly, but it basically had no traction. So there's a couple things to look at here, just kind of bringing us in. We still have fib targets on the upside for 2167, 2304, 2388 from that standpoint. And we're looking at that's a longer term pattern. The weekly, though, is suggesting, the algos are suggesting we have a couple more weeks to the upside with the key support right now on the 10-period moving average, which is going to put us 1924 as we speak. But that is I'm just trying to get a rate of change here, going up about 14 handles per week. So that's going to be 1940, following week 1960. Basically, everything points at 1960, 1970 level as major support. And I think we just go sideways here, don't get a lot of action. The like I said, the PPMs look pretty good. Even if we come back over here and they start to flatten out on the projections out, this is out 4, 5, 6 weeks, which is probably doesn't have a lot of relevance. The first 3 weeks do, but you can see the moving averages are looking like they're going to flatten out somewhere around into mid-May, like a month from now. So there's 3 or 4 weeks still that we should be sideways with a bias to the upside, and the extreme on the downside is going to be that 1920, 25 level would be the extreme that I talked about on the daily. Take a look at Bitcoin. We'll start with weekly. Weekly still trying to weaken a little bit. We had the same kind of event similar to gold, where we got a weekly RXT sell, and then while we were able to print higher, and let me blow this up so you can see it just a bit better. We're able to print higher. We're pretty much the close where I have my cursor right now is where the close was. We've literally finished every week right on that line. So while we trade a little bit above and down, that center line at the close was, let me get the close on this bar here, which was 28,504. The following week, 28,186. Next week, 28,340. And right now we're 28,324. So we've just been flatlined. But what we're seeing from the algos here is that they're starting to look like we're going to test the 200-week and the 10-week moving average are similar values right now. And those are the numbers where you're going to watch really closely. So 25.5, that's the number I've been talking about for weeks now. That's still your number. And it looks like the algos are suggesting we've got some pretty good stability. If you look at the PPM numbers off in the white PPM 1, 2.15. So this is a very robust trend. The probabilities of getting below that number is not very high. And we're looking at it going up right now. Let me get a value for you. It's going up only about $200 per week. So ultimately, it's probably 26.2 is going to be where the support is. Doesn't mean that's where we're going to break down. Chances are we bounce off of that level and we come back into this 200 again is 25,750. So these two values are going to be very important in this pattern as we go forward for the next several weeks. Okay, folks, that's gonna going to do it. Just looking at some comments here. Yeah, I see some gas talk. We're back here. There's a truck stop gas station right behind my office right here. And I think when I came in, it was 480. Yeah, 489 right now. I'm sorry, 389. That's where we're at. I get the four handle stuck in my head. But that's a pretty big number. We were down to about 330. So, yeah, so let's do a couple questions real quick here. FF, you've got a question about flow to money market funds. No, it's not going to affect anything. The only thing it could affect is that these bankers will wake up and give away some earnings and start paying out some interest if they want to keep deposits. They have a number of ways they could do that. I mean, they put some decent rates on some CDs. They can get some little more stable deposits. There's plenty of things they can do. And listen, it's like anything. It's the open market. You know, where are you going to put your money? You're going to put it in at 4.5, or you're going to get some joker at 0.7. I was talking to somebody the other day, and they have a big customer that had a $3.5 million deposit at a community bank. They were paying him 0.7. And basically, I had talked to him, and I just said, hey, get a Treasury Direct account. You know, that's why they want to play, is move the money out. I mean, you know, that's the banker's problem to do that. They see a few of those big deposits leave. They're going to start paying up to keep the deposits on the books. They're going to give up earnings to do that. But let's face it, you want the deposits. What do you want here? And you got to get a balance. And ultimately, if they do the right things, then they get the deposits back. They can compete. They have to do a better job about running their bank. That's really what it comes down to. So I don't see any issues there. Yeah. So if you go to Treasury Direct, you'll see they're actually. I think I saw last time I was there, they had some bill paying capabilities as well. And somebody's talking about the FOMC meeting minutes. Yeah, there's not going to be. I don't think there's any pivot notes in there, but they usually tend to have some positive impact. That's for sure. Yes, Trader SL, I will include those. Excuse me, my nose won't stop itching. Yeah, one of the things I'd like to do, Pam, is actually have a day where we pick some bellwether stocks. Maybe what I'll do is maybe we'll do a survey of some sort, some kind of thing on Twitter or something to figure out something like that. Well, I'm definitely fine with doing that. Yeah. Yeah, so I see Beef is commenting on some of the things I said a few minutes ago. Yeah, listen, you want my money, you got to pay me, and that's a very healthy system, not an unhealthy system, and that's how you want it. That's how the banking system always goes, and that's how it should work, right? It's like anything. You got it. If you're in the business of holding deposits, you've got to pay some returns, and you know it's you just have to and then you got to run your bank right. You know, asset liability management, ALM, right back. That's what you got to do, and you got to make good choices, and you got to do the things necessary to run a good bank. Like I told you folks before, I spent a good part of my career in working with basically gap analysis and working with banks on these mismatch levels and how to offset them using derivatives, whether it was options or futures. how to put that out there. Matter of fact, the market grid exists because of that job I had with the banks at the time. I ran a consulting service at about 35, 36 banks, large banks that use that service. And basically it was about how to manage that gap and how to put spreads on, primarily yield curve spreads, to make that offset some of those gaps. And it was a good job. I did it for quite a few years, actually, from about 94 through maybe 98 that I ran that service. I started the portfolio management company in 98 with another gentleman, and that kind of changed the trajectory of where a lot of my career has went over the last 20 plus years. Hard to believe. And now there's always twists and turns, folks, what you get involved in. So anyway, yeah, so okay, folks, I think that'll do it. I'm just looking at a couple of comments. Always nice to interact with some of the timeline here. So yeah, just remember at the end of the as we're coming into the end, give me a couple of triggers that we can talk about, and we'll do a few minutes of that stuff. You know, as I told you folks on Saturday, it was really a hangout meeting. That was a lot of fun to hang out on Saturday and just make sure you know, kind of keep in touch with the community and all that. So yeah, so like I said, we'll see what happens out of town. I don't know that I'm going to be able to pull off anything like a live stream or anything like that, but I may have some comments that I put out there. So thanks a lot for watching. Sunday night, happy Easter, everyone. And I will be talking to you tomorrow night, same time. Thanks a lot. See you then. Yeah, R1S2, Kim. There, FF just put it up on there for you. Thanks, FF. Appreciate it. Yeah, watch for this thing at the bottom. There may be a little rally after the London Open. So watch how the price action is, folks. Yes, thank you, moderators. Thank you, Smurfs. See you guys tomorrow night.